If gold is revalued by the U.S. government overnight, would it be 36,000? Gold and silver seem to be quite volatile right now. Why do you think that is? They don't want you running to gold and silver, so it still benefits governments and central banks to keep the price suppressed. And we still have spot silver, something like 33 or 35% above that 200-day moving average. 10% away is a lot. And by the way, I did not see any gaps in either spot gold or the spot silver contract. I'm getting confused about the order of events during a currency reset. Does hyperinflation have to happen before the first gold to dollar reset? When the revaluation of gold takes place, how do I buy a home? Give the bank gold in lieu of fiat? If not, who will buy my gold? When it comes to paying off that fixed rate debt like a mortgage, I can't sit here and tell you how long for sure. If gold is revalued by the U.S. government overnight, would it be 36,000 global M2 supply fundamental value or the U.S. fundamental value 135,000? More than likely, and I should do this when I have a minute. It'll be interesting to do it, but I would think that it'll be country by country, actually. Though I also think that it will probably be a globally coordinated effort so that there's really no place to run to. Because if they did it in the U.S., then all the wealth would run to the U.S. If they do it somewhere else, it's going to run there. So I don't know. It could be one or the other, and we don't know what the coverage is going to be yet. And we also don't know how much more of this stuff they're going to print before they do that. So any of this could look like chump change, nor do we know really the value of the derivatives against all of the treasuries and all of the debt that's out there. So there are a lot of unknowns. So even when you're looking at those numbers, those would be a minimum. But my guess would be, since every country is going to have to deal with their debt loads, that it would be a country by country revaluation, but it would more than likely be coordinated to happen at the same exact time so that there's no place to run to. And Jambobsky says, hi, Lynette, gold and silver seem to be quite volatile right now. Why do you think that is?
The part investors should notice is not the gold price target, but the idea that governments may need to move together to contain capital flight. As Lynette Zang points out here, a unilateral reset would immediately pull global wealth toward whichever country moved first, creating a dangerous imbalance in sovereign markets. That matters because global debt now sits above $300 trillion, while derivatives exposure remains many times larger than official balance sheets imply. Markets rarely price that kind of systemic stress honestly until confidence breaks. Next, Lynette Zang discusses why gold and silver volatility may be more deliberate than most investors realize.
Okay, so going back, and we've talked about this with the big run-up in the spot contracts right along. Number one, they don't want you running to gold and silver. So it still benefits governments and central banks to keep the price suppressed. Number two, technically, they were treated as a trade, right? So it wasn't a flight to safety as much as it was a trading vehicle. And of course, in speculation, they pushed the prices of both gold and silver into overbought, not overvalued, overbought territory. So there are several things that can happen. And this is actually what's happening, is that it's staying inside of a range to work off that overbought circumstance. You know, we still have spot gold, 13.55 or whatever it was that I said earlier, above that 200-day moving average. And we still have spot silver, something like 33 or 35% above that 200-day moving average. 10% away is a lot. So technically, with just from a pure technical vantage point, what is happening is the same thing that happens to every overbought circumstance is then it can stay overbought a lot longer than people would think possible, just like the stock market's overbought, overvalued, over everything. But since there's so much money that's sloshing around in the system, it just sloshes from here to here to here to here. And plus, they're printing more of it constantly anyway. So my personal opinion as a technician is that it is working off that overbought position. And that I'm good with that.
A market can look strong on the surface while quietly telling a very different story underneath. As Lynette Zang points out here, overbought does not automatically mean overvalued, especially when central bank liquidity keeps pushing money into the same crowded trades. Silver, sitting roughly 33% above its 200-day moving average, tells disciplined investors that momentum can distort price far longer than logic suggests. The danger is that retail buyers often confuse temporary price exhaustion with a broken long-term thesis. Next, Lynette Zang talks about why volatility itself can become a tool to shape investor behavior.
I don't care. That's a strong foundation. That's what I believe is really happening with it. That and the fact that the government wants you away from it. They don't want you holding it because then it becomes invisible to them. And the only thing that they have is perception management. Oh, look at how volatile it is. Honest to God, did all those 33 buyers globally of gold and 36 buyers globally of silver, did they evaporate? They didn't rush into the market. They didn't rush out of the market. That is trading. Don't believe the lies. And Ernest DeBella, rock and roll hoochie coo. What does gap down mean? Okay. Gap down means, okay, this is where Microsoft closed and this is where they opened. So the difference between those prices is a gap. And at some point, all gaps get filled. And by the way, I did not see any gaps in either spot gold or the spot silver contract, or I would have brought that up to you. So if it gapped down and now it's below that level, at some point, the spot price of Microsoft will go up to fill in that gap, and then it can continue down again or continue up. We'd have to see. But that's what it means. It closed here, and I'll show you gap up too. Gap down is the spot price closed here and opened below that level, and the difference between the two is referred to as the gap.
Sometimes the loudest warning sign is how aggressively normal volatility gets used to scare ordinary investors away. As Lynette Zang points out here, physical ownership sits outside much of the financial system, which makes it harder for institutions to monitor or influence once investors move capital there. Her reference to only a few dozen major buyers worldwide suggests price swings often come from paper trading, not a collapse in underlying demand. Even the gap discussion reminds viewers that technical moves can distort emotional decisions. Next, Lynette Zang unravels how market mechanics can reinforce larger currency reset concerns.
Gapping up means that it closed here and it opened here, and the difference between the two is referred to as the gap. And again, all gaps will get filled. I can't tell you exactly when, and it could take longer than you would ever think, but once a gap is created, at some point, all of those gaps get filled. And what does it mean when they say 4,000 units of silver contracts were stopped by Bank of Blank yesterday? That's a good question. Can you see if you can pull that up, Tom? I don't have my phone, but definitely pull that for me. And I didn't see that. So, Ernest, thank you for bringing that up to my attention. We'll see what we can see right now. Otherwise, I'll talk about it more next week if we can't find it now. Is there another question? Okay. And Connor McCarthy 5960 asks, Lynette, I'm getting confused about the order of events during a currency reset. Does hyperinflation have to happen before the first gold to dollar reset? Yes, it does. Or can no confidence alone trigger a revaluation? Well, what no confidence does is it triggers the rest of the hyperinflation. And that monetary velocity chart that I showed you before, could you, okay, so is this just in YouTube form, that comment?
Yep, you're all good.
Okay.
The deeper issue here is not the chart pattern, but the sequence of confidence breaking inside a currency system. As Lynette Zang points out here, a loss of trust alone can accelerate money velocity, and that is often what pushes inflation into something far more disruptive. History from 1923. Germany, to more recent emerging market crises, shows confidence usually fails before policymakers admit the damage publicly. The mention of large silver contract activity also hints that institutional positioning can reveal stress before headlines do. Next, Lynette Zang discusses why hyperinflation often comes before any official monetary reset.
Could you do me a favor, Tom, and I'll look at that and come back to that next week. Just make sure I have that question. But could you please pull up the M2V from the Federal Reserve, the Fed? So I'm going to show you this on a longer term basis, and it'll make a bit more sense in that hyperinflationary question. There we go, that first one. Yep, perfect. Can you put that on the screen for me, please? And I think that goes back to, what's the earliest date on that? 1960, okay. So yeah, because this is money stock. Now, remember, M2 is not the broadest base of money, but can you see how taking on debt actually did stimulate the economy? But that peaked, you can see where it hit the top level in 1997. And after that, even though certainly a lot more debt was taken on, it did not prove stimulative to the economy. And while there were little movements up that you can see, you can also see that you have lower and lower highs, and then a huge drop off in 2020. And then we get this big spike that is really, frankly, bigger than anything that we've seen, but other than leading up to that peak that hit 97. So that was a pattern shift peak. And that massive runoff that we've seen since 2020 indicates all of that high inflation and that loss of confidence that we were experiencing. So looking at the velocity of money on a longer term basis, can you see that big pattern shift that happened after that massive decline in 2020? And this K-shaped recovery is just the people at the top that are doing well. Everybody else is not doing so well. So what I'm looking for next in this is another big run up. And what that really tells you, going back to that question, does hyperinflation have to happen before the first gold to dollar reset? Yes, because it is a function of attempting to regain confidence in the system. And it works for a heartbeat of a minute, except they do not change behavior. And so typically, you can come back to just me now. And if you have any more questions about that slide or that chart, just let me know. But what happens is globally on average, we can expect 3 overnight resets because they do that to regain the confidence.
Most investors never notice when debt stops creating growth and starts simply masking decline. As Lynette Zang points out here, money velocity appears to have changed after the 1997 peak. suggesting each new round of liquidity now produces weaker economic output than before. The sharp break after 2020 matters because it exposed how stimulus can inflate asset prices while leaving most households financially weaker. The K-shaped divide has become a warning that confidence is now more fragile than official data implies. Next, Lynette Zang discusses how that confidence loss can reshape the value of gold itself.
When the revaluation of gold takes place, how do I buy a home? Give the bank gold in lieu of fiat? If not, who will buy my gold? That is a great question. And I think that there are several answers to that question. And it kind of depends on if there has indeed been an overt gold confiscation, then the government is probably going to require any accumulation of gold from the banks. So you may be able to use the gold to buy that. And in some like Battle Bank, Rick Rule's bank, I mean, they're very attuned to gold and using gold as equity to make the purchases. So it kind of depends on the bank that you're working with. But you might actually have to use whatever the money of the realm happens to be at that moment, whether it's dollars or euros or it's crypto or whatever it is, in which case we are prepared to convert that gold into whatever that local currency is, and then you would use that to buy the house. Because remember, you're going to have a contract on that. But you're going to, I'm not exactly sure why you would need the bank other than as an intermediary between the seller, because you would not be taking, well, you get to do whatever you want, but if you're executing our strategy, you're not taking on debt to do it. So you're going to be buying the house outright. So if the bank is acting as an intermediary, then yeah, we'd convert it into the local currency.
The practical question is not whether gold rises, but whether it can move through a financial system under stress. As Lynette Zang points out here, ownership only matters if investors understand how to convert that value into a usable form during a policy transition. History shows governments often tighten control over hard assets when confidence in paper money starts fading. For families planning around wealth preservation, liquidity could become just as important as the metal price itself in that moment. Next, Lynette Zang talks about how repayment strategy could matter more than simple asset appreciation.
And you'd give the money to the intermediary to give it to the seller of the house. But if you're working with an individual, that individual might well prefer to be paid in gold, even the collectible gold. Because at that point, everybody is quite clear on the value of all of this stuff, which is zero. And it doesn't have any value because it's a stated value that gets inflated away and costs nothing to create. So it kind of depends. But, you know, mostly our intention, as you need it, is to convert it into whatever that local currency is. You pay it and it's done. And we're going to be doing that. If you're sitting in a property and you have a mortgage, we're going to be converting it so that you can, in that local currency, pay that mortgage off. That's the plan. So we will buy your gold, but it's going to be easier and faster, especially if I'm juggling, right? Because honestly, in the exit strategy, understand that our goal is to capture the most that we can for you. And there could be a number of different avenues and tools that we can use to do that. But it's still going to have to be planned. So especially when it comes to paying off that fixed rate debt like a mortgage, I can't sit here and tell you how long for sure when they do that overnight reset that the spot price is going to stay up at that level before that too then resets.
What sounds like a simple sale can become complicated once timing starts controlling value. As Lynette Zang points out here, the real challenge may not be finding a buyer, but deciding when to exchange a hard asset before market conditions shift again. Investors often focus on the upside target and ignore the execution risk that comes with a narrow window. Paying off fixed debt during a monetary disruption could reward those who planned early and punish those who assumed liquidity would remain normal. Next, Lynette Zang unravels why timing that exit may become the most critical decision.
And then starts to march higher again. I can tell you that globally on average, that's roughly a 9-month window. So knowing that, presuming a repetition of history, we can anticipate, since that's what happens most of the time, then we can anticipate that 9-month window. And that means that everything is going to have to be scheduled out in a way that does not hurt the price that we're going to get for the coins. And that means, it's a precision execution. We're going to have to take care of our clients first before we even take care of ourselves. We must put the client first, period, end of discussion. So if you bought it from us, that means you're a client and that means you go first. If you bought it elsewhere, I'm not saying that we won't buy it back from you, because that was like one of the big things when we were talking to our wholesalers. But it's not so precision. And the reason for that is because our wholesalers know what they sold us. And so they can give us pricing and make that execution like that. Whereas if you bought it someplace else, we first have to send it into them. They have to verify that it is what everything says that it is before they'll give us a bid. All of that takes time. We aren't going to have that time. We'll have it in some cases, but generally speaking, if we're executing, say, the debt payoff part of the strategy, we don't have that time, and we can't push somebody else out of the way that is a client that's been working with us to put somebody else in. It's not going to work like that.
The overlooked risk is that a profitable asset can still become difficult to monetize under pressure. As Lynette Zang points out here, historical resets have often created a limited 9-month period where pricing remains favorable before markets adjust again. That means execution may matter more than prediction, because even strong gains can disappear if sellers enter an overloaded system too late. Investors who treat wealth preservation like a passive trade may underestimate how operational bottlenecks can affect real outcomes.